Good afternoon. Welcome to our seventh Pillar 2 technical series session, which today we'll be covering GloBE elections and certain aspects with respect to the flow-through entities. For those that have tuned in historical sessions, this represents the seventh one. We're host 7 out of 10, and just to give you a recap for those that have missed some of the previous sessions, there are recordings on our YouTube channel. If you click on the link to the left over here. As you know from before, we up to this point we have done an overview and certain aspects of the transitional safe harbors in the first session. We did a session where we looked into the nuances of classifying your M&E group, and even dove into rather complex M&E groups and what the GloBE rules on Pillar 2 say today. In the fourth session, we gave kind of an overview of tax accounting and how it will interplay into Pillar 2, going into this new world we live in with Pillar 2 as law in many jurisdictions. And then the last two sessions, we did a quick run through of Article 3's GloBE income and loss rules. And last session, we did a full-scale scope of Article 4's adjusted covered taxes session. So for those that have tuned in, today we're going to talk about GloBE elections and how they interplay with the calculation of the top-up tax that we have been covering for the past 6 sessions up there. So today we're going to give a recap now, which we're doing as we speak, and then we'll go into some of the Article 3 GloBE elections. Then we'll talk about the Article 4, and then we'll talk about other articles, specifically to setting up your M&E group and things like that. And then kind of what we call the GloBE elective provisions, really talking about the safe harbors and measures that the OECD has talked about going forward. And then we'll give some quick closing comments. So without further ado, though, I'd like to introduce myself for those that have not tuned in. My name is Justin Metcalf. I'm a director with the Charlotte, North Carolina office of Forvis Mazars, and I will let my other colleagues here introduce themselves.
Thanks, Justin. Eric Flickiger. I'm a partner with the Forvis Mazars U.S. International Tax Group, focusing working hand in hand with Justin and Neil on the Pillar 2 initiative for our firm.
Thanks, Eric. I'm Neil Rolfe. So I'm an international tax partner based out of London. My main focus is on insurance clients. I'm the global head of insurance for Forvis Mazars, and have been looking at Pillar 2 for well over 3 years now, and along with Eric and Justin, I'm part of our Forvis Mazars Executive Committee for delivery of our Pillar 2 solutions and technical knowledge out into market. Back to Justin. I think you're finishing off the recap for us.
Yeah. So as I mentioned earlier, and thank you, Neil. Today, what we're looking at. So just to get to level set with those that are tuning in. There is a jurisdictional top-up tax liability. This is what's known as the Article 5 top-up tax in the GloBE model rules. And if you look to the very left of this chart that you see in front of you, there's a whole lot of variables that go into making the current year top-up tax liability for a jurisdiction. We'll talk about a little bit about the additional current top-up tax piece. And then, of course, QDMTTs is something we covered in a prior session there. So please tune into that. I believe that might have been session 2 or 3 on that one. So, kicking this off, right? Let's go through this. So, just to recap, your top-up tax liability is equal to your top-up tax percentage, right? To figure out your top-up tax percentage for a jurisdiction, you need to compare the GloBE minimum rate to your GloBE jurisdictional ETR. To figuring out the GloBE jurisdictional ETR, you need to know two components, which is what we covered in the last 2 sessions. So what are your Article 4 adjusted covered taxes as your numerator, and what is your net GloBE income or loss in that jurisdiction as your denominator? You compare that delta to the excess profits of a jurisdiction, which is really your net GloBE income again under Article 3, less any substance-based income exclusion amounts covered under Article 5, sorry. So, we're not going to go into the nuances of this because we've covered this in a prior session. Today, we're strictly focusing on all the elections that come to mind in formulating this calculation and where there could be benefit for your organization, or when you're doing these exercises to understand where things come in and where you can have added benefits to your GloBE calc. So let's do a quick set. So we're going to talk about Article 3 elections, but just to give a quick recap, your Article 3 net GloBE income is formulated by three components. What is your financial accounting net income or loss, your FANL? What are your book to GloBE adjustments, which, in the next slide here, I'll show you there's a listing of all of them that we covered in our Article 3 session, less any exclusions for international shipping income. What you see in front of you here is a bulleted, generalized listing of all the different book to GloBE adjustments that currently are in place today. The OECD has talked about adding some, even with respect, post December 2023 guidance. So this list could potentially grow larger, over time, but this is where we are today. And we'll cover some of these elections that are noted in here in the next segment of this presentation. But once we figure out our Article 3 GloBE income, we need to understand what is our Article 4 adjusted covered taxes. That math, that answer is dictated by four components. One, what is your covered tax expense, which is generally your FANL current tax expense on the books, right? Then you add any certain additions or reductions to covered tax expense. Here's that component where you talk about current tax expenses that may, where things may never be realized within a certain prescribed period for current taxes. That's where that comes in. Then there's this component which we'll talk about called the total deferred tax adjustment amount, the DTAA. We'll talk in length on the GloBE loss election, which allows you to supplement this DTAA amount in lieu of the GloBE loss election, which the result is a GloBE DTA going forward that you use in future years to help your adjusted covered taxes. And then after that, you consider certain increases or decreases that are captured in your OCI accounts, right, that need to be adjusted to true up your numerator for GloBE purposes. So that's kind of a quick, previously on the last session that we talking about, what we've covered up to this point and where the elections play into today. In front of you is kind of a quick overview of quite a bit of the elections there, and you'll see, all these we'll cover in rather fluent detail in the next sessions coming. You'll see, there's a variety of different GloBE elections, and in doing the GloBE elections, right, there's a variety of different modeling pieces that come in. So we're gonna peel a layer of the onion today to dive in. But before we do that, let's kick it off with our first polling question. So, has your company considered full scope GloBE computations for any jurisdictions in its M&E group? I see we have a question here about, is there a way of getting slides for the previous sessions? Yes, we can certainly send that over and make that available. I believe it should be on there, but if it's not, we can handle that.
I think, Justin, also, if you click on any of the Watch Now links, then you go through and the slides are attached before you have to watch the presentation. So you should be able to access them that way. We'll have a look specifically at the YouTube channel as well.
Perfect. Let's just give this a minute. And once we're done with this polling question, we're going to kick it off over to Eric, who's going to take us through the very first segment of elections under Article 3, which affects your net GloBE income or loss. So there. So quite a bit of you say it's not applicable, and a lot of you all have said no. So the presumption is you're probably considering the transitional CBCR safe harbors today, which is in line with the market thought from my perspective. What about you, Neil?
Yeah, I mean, we typically find, certainly on very large groups, that there's maybe 2, 3, 4 jurisdictions that just don't quite make it. You know, there are some clear known
Stateless
ones, you know, like
entities.
Singapore, you know, low tax rate jurisdictions, you know, Ireland maybe has to do a QDMTT, you know, because of the 12.5% rate, and it moves up to 15%. And then if there are any tax jurisdictions where there are specific tax incentive schemes at the moment, then those also can drop the rates down, you know, the effective tax rates below 15% when you do, in particular, the ETR calcs. So I think for a lot of groups, it's a compliance burden around making sure that they have a qualified country by country report, but for others, there's, you know, they want to make sure that they can do the full model rules for, you know, if the permanent safe harbors aren't as useful as the transitional ones, and have to do it for, as I say, a limited number of jurisdictions, but not all. Yeah.
Good to know. Yeah, that's interesting. So without further ado, let's kick it over to Eric. Eric, please take us through the global elections under Article 3.
All right, thanks, Justin. Yeah, and we'll move quickly through these just to make sure we cover the content and the slides here and talk on each topic. But you know, the slides are here available for you to come back and review. And certainly, if you have questions, feel free to reach out to the presenters here. So, Article 3 elections. You know, these are elections that impact the adjustment of FANL to get to GloBE income. As Justin mentioned, here are the adjustments that are available, and we'll go through the various elections here that can impact those adjustments, starting with the stock-based compensation election. So what you'll see as a common theme throughout these elections is that a lot of these elections are in an attempt to align the GloBE income adjustment to mirror the local tax treatment. So there's not a mismatch between GloBE income and local tax treatment. So in this case here, this is an election that will allow a taxpayer to substitute the financial statement stock-based compensation deduction with the actual deduction that's available for tax purposes in a certain jurisdiction. So it's limited to this is limited to compensation expenditures. And it applies to stock-based compensation for employees and non-employees, as long as that aligns with the local tax rules. The impact here is that you can essentially take a deduction that's based on the value of the stock at the exercise date versus the stock-based compensation allowed in the computation of your financial accounting income or loss. There is a procedure. This is a 5-year election. You'll see most of these elections are 5-year elections. It must be made by the filing constituent entity in a jurisdiction, and it'll apply to all constituent entities located in that same jurisdiction. Again, this is a 5-year election, starting within the year of the initial election. And you know, we've got this comment here on all of our slides on, you know, when does it make sense to use this election? In this case, it's when you have significant tax deductions that are different than the deduction that we see in our financial statements, you know, and that could, you know, throw off the impact of an ETR in certain years. So making this election to align with the actual tax deduction may make sense for companies as they're trying to align and report the appropriate ETR. So this is the stock-based compensation election, and it's in Article 3.2.2. Moving on here, similar to the stock-based compensation adjustment election, The realization principle election is an election that can that taxpayers can make to only recognize gain or losses on assets or liabilities in the year of disposal, and if that's in the year of realization, versus adjusting for the fair market value in their financial statements. So this can apply to all assets. There's also an option to limit this election to tangible assets or to assets that or the assets and liabilities of constituent entities that are investment entities. So the impact here is that the gain or loss is with an asset or liability is only going to be recognized when the asset is disposed versus the value changing on a market-to-market adjustment. This is another 5-year election, so it's an election that needs to be considered over a long-term period. And again, this is one that you may want to consider making when your local tax base is based on realizations versus the fair market value of your assets and liabilities, and the difference. If there's a difference that's happening, there's an issue with your ETR getting below 15%. That's when this election may be helpful. The aggregate asset gain election is an election that permits multinational enterprise groups to spread the gain or loss from the sale of tangible assets over a 5-year period. This is really to mitigate the impact of a large gain in 1 year on an ETR computation. So spreading this gain over a 5-year period may be helpful in that sense. And we use the very technical term here on when to use this large, lumpy, irregular gains. That's when you may want to consider this election. This is an annual election, so it's not a 5-year election, but it is made on a jurisdictional basis. So all constituent entities within the same jurisdiction need to follow this election if it is made.
Hey Eric, one quick thing I want to add. Hey, Eric, one quick thing I want to add to that last point too is, for those tuning into that aggregate asset gain election, there are certain ordering rules on how you do allocate that gain once you do make that election. So just when you're thinking about doing that, look into the GloBE commentaries. Give pretty robust commentary as to how you allocate it within that that period. So just want to throw that out there.
Thanks, Justin. The next election here is the jurisdictional consolidated transaction election. Essentially, this election would allow a multinational enterprise group to eliminate intercompany transactions between entities within the same jurisdiction. This is tax base allows for intercompany transactions to be eliminated. Then this could help for GloBE purposes as well. It also could help just with simplicity, following the same methodology that we use for local tax reporting for GloBE reporting as well. And the equity investment inclusion election. So this is one. So typically the equity gain or loss is excluded from GloBE income. This would allow, this election would allow a M&E to actually include the gain or loss from an equity investment in the GloBE income. So just something to think about if there's substantial tax gains or losses that are, not matching with the financial statement reporting. There's still an effective tax rate that's getting below 15%, and this may be an election to consider. It's a 5-year election. Again, it applies to all ownership interests in that jurisdiction. So it's one to consider with a long-term view as well.
And just to add some color to that too, adding to that, like, so, just thinking about this from like a U.S. tax perspective for those that are particularly concerned on this, I usually think about this election being beneficial, right? Where you got a U.S. seller that owns, let's say, stock of a CFC, and that CFC stock is being sold with no 338G election or any kind of asset type, not in an asset deal, just strictly a stock deal, right? To another like buyer, say U.S. buyer, right? You might have, outside the U.S. you have your 1248 considerations and all that fancy stuff, but from a strict Pillar 2 perspective, right? Adding to what you said, Eric, right? You would exclude this equity gain or loss, that the difference between the basis of the stock and the gain and the fair market value, right? And from a U.S. standpoint, right? This, let's say you're paying any U.S. taxes, right, on this gain that you've had, right? Without making this election, you don't get the benefit of including that income and the taxes on there. So if it's a high ETR sale, right, this could potentially put you in a position where you're paying unnecessary tax on the same item of income. So just something to think about when you're considering this. But sorry, I'll, in the interest of time, I'll kick it back to you there.
Yeah, and our later sessions when we talk about restructuring and transactions with regard to Pillar 2. Another adjustment here is the debt release election. So this allows for M&E to exclude income that's recognized from a debt release and its financial statement income from GloBE. So align with likely the tax treatment in a local jurisdiction. So if there is debt release that's not taxable in a local jurisdiction, then this election will allow the entity to align with the local tax treatment.
Yeah, we have that in the UK, Eric, for particular types of debt release. So ones in particular, and the rules kind of mirror this, ones where you're about to go into an insolvency, or in the case of an insurer, you have like a massive loss event and you've got some debt, and that debt triggers, it suddenly switches into equity or something like that, or in fact writes off. You wouldn't want it to write off and then give you a huge tax charge at the same time it writes off. So the UK rules provide that in that circumstance, you don't get the tax charge. You then wouldn't want a top-up tax in relation to that imposed by Pillar 2. So this rule kind of allows you to avoid Pillar 2 causing, messing up the local tax base.
Yep. Yeah, and there's certain types of insolvency where this can apply, and there's limited situations here, but yeah, this could be something that's beneficial given specific facts and circumstances. Finally, the portfolio shareholding election. So this is an election to include dividend income from short-term portfolio shareholdings in GloBE income or loss. So this really is probably a kind of a simplicity type of election for M&Es to consider. Essentially, if we have a significant amount of portfolio shareholdings and a significant amount of transactions year over year, determining which transactions with stock holdings are, have been held for less than 1 year may be difficult and time consuming. So this would allow the M&E group to include all dividends from portfolio shareholdings in its computation of GloBE income. It's a 5-year election. And again, this is really one that's probably more of a way to simplify the process of determining GloBE income. I don't know if Neil or if Justin, you have any other comments there?
Yeah, we see this quite a lot in the financial services sector, where there's holdings in, let's say, Coca-Cola or something like that across a range of different investment vehicles. and those shareholdings go up and down, driven by what policyholders or what investors say they want to invest in. And there's no way that that the information to determine what is in relation to the part of the shareholding that you've owned for more than 1 year is different from that which you've owned for less than 1 year. So people just can't do it in the rigid way that the rules originally set out. And the alternative is to make this election, over that short period holding, so that you can actually do the counts at all. And that's where we sit most.
Thanks, Neil. All right, so I'm going to pass it back over to Justin to cover global elections in Article 4.
Thanks, Eric. And so right now we're going to talk really about what are those that factor into adjusted covered taxes, right? So there is a component here where as we said earlier, you have your current tax expense, you have certain additions and reductions to covered tax expense. Really, these elections that we're about to talk about really relate to item 2 and 3, and really 3 here, which is the DTAA. So, what are these, right? So, well, I guess before we talk about that, let's first do the second polling question for everyone's CPE purposes. So, has your company considered the impact of any of the GloBE elections related to Article 3 in any jurisdiction? I would say that
if no one's actually looked at like the full model rules calcs, Justin, chances are people are not going to have done this. But there's a lot of elections in there, aren't there?
Yeah,
that's what I think. Every time I look at it, I'm like, some of them there's a reasonable amount of modelling that you might need to do in order to be able to work out whether it's going to give you a beneficial result, because they last for so long, don't they? Like the 5-year elections. But just want to make sure you're in the transitional measures.
Yeah. So I mean, there's a presupposition here that you have to have looked at that. So I think one thing though that we did identify in the previous session for those tuning into Eric's pieces there, right? If you're a U.S. shareholder, right? See a U.S. company selling CFC stock, there is an instance here where some of these Article 3 elections could be beneficial, right? Because if specifically where you pay, your tax high on a stock sale of CFC stock. So just that was a deliberate intention of throwing that out there for those that are thinking about that. So just something to consider on that front. So it looks like quite a bit of you said not applicable, and a lot of you said no. Okay, well, hopefully this will be helpful for those that said no on there. So let's keep plugging away. So let's first talk about the unclaimed accrual election. So what's an unclaimed accrual before we even talk about this, right? What it is it's really any increase in a DTL recorded in the FANL of a constituent entity for a fiscal year that is really not expected to be paid within the subsequent 5-year period that has been enumerated in Article 4.4.4 of the model rules. This unclaimed accrual election really relates to there's a piece in 4.4.2 of the model rules that says you have to increase your adjusted covered taxes by the amount of any disallowed accruals or unclaimed accruals paid during the fiscal year. So, what is this? So the election here, it's meant to not include that DTL, right, in determining its adjusted covered taxes. By doing that, it helps you. What you'll see is that it helps your ETR by adding it back, right? Adding it back, and the effect of it should increase your ETR going forward. So, the impact here is it provides M&E groups with the opportunity to simplify their GloBE compliance in jurisdictions really where the GloBE ETR exceeds 15%. You're really not considering any of these post adjustments there, where you're at a comfortable point post the 15%. There's it also asks it takes off the onus of having to track, because we know the GloBE rules mentioned in the prior sessions love tracking mechanisms. So no need to monitor when your DTL is reversed. It's embedded in the election. The procedure for this is you make it on an annual election, and it wouldn't be included in the DTAA or in one of those additions to or subtractions to cover taxes. So again, you use it. When do you use this? You use this when the ETR is clearly above the 15%, and removing it makes life easier for you from a data standpoint for Pillar 2 computational purposes. So without further ado, to keep the time here going, let's talk about what I've heard a lot of others talking about, and let's talk about Article 4.5's GloBE loss election. So if you recall in our earlier today, I mentioned that there's the DTAA that you add to your additions and reductions to cover taxes, right? If you make a GloBE loss election, you forego the exercise of computing the DTAA for that jurisdiction, in lieu of a GloBE loss DTA that's created. So what it really is it's an alternative to the DTAA rules, and it's basically what it is. It's a jurisdictional election that creates a GloBE loss DTA in every year where there is a net GloBE loss under Article 3 for that elected jurisdiction. What happens is you take the loss, right, that you created in that year, and you multiply it by the minimum rate, which is the 15%, right? And what it does is it starts creating an account, right, of all these DTAs, GloBE loss DTA, that you can then use in future GloBE years, right, to offset, to help your Article 4 numerator, right? It's like a lot like an NOL carry forward, but it's just a DTA on that carry forward that helps you in subsequent years where, in that jurisdiction where you might have had the loss, and now you're able to use it to offset gain going forward, right? So the GloBE loss DTA, it's a net once that GloBE loss DTA is used in a subsequent year, right, the DTA tracking account must be reduced, right? Just similar to like how we do with every other tax account, like the PTEP pieces, like we had PTEP regs that dropped recently, and it's a jurisdictional attribute for the M&E group, and it's important to note it can't be transferable. Once that constituent entity where you made the election so you can't transfer the GloBE loss DTA that you've created as a GloBE attribute to another M&E group if that constituent entity is the one that created it. So it's a one-time election, so it must be filed with the first GloBE information return for the M&E group, where that constituent entity that has the GloBE loss is located, and it's not applicable for a jurisdiction with an eligible distribution tax system that's been enumerated under Article 7.3 of the model rules. So that's another thing to consider. But it can't. So once you do make it, it's a one-time election. You can only make it on your first GloBE information return. But if you do make it and you decide, you have cold feet on moving forward with it, you could always revoke it. But and in such a case, any GloBE loss DTA must be reduced to zero, and certain true-up recapture adjustments will be effectuated in that year where you revoke it. So that's one thing to think about as well. It can be made if you have a flow-through UPE. So if your ultimate parent entity is a flow-through entity, it could be made for the UPE, but it cannot be made for other entities in the UPE jurisdiction. Consider that piece. There's a little bit of nuance there with flow-through entities specifically on that front. So, the low and all of this is that it's generally expected to be of greatest utility right, where you have, a jurisdiction that does not impose a corporate income tax or imposes one at a very low rate of tax when that election is made, and then in subsequent years, you don't have that, ETR to boost you, right? So creating losses in like one of these these low tax jurisdictions, this is where you want to consider it. So you use this when the GloBE loss is greater than the tax loss, and you're in a jurisdiction where you're going to really need that instead of having, and you don't really get the benefit of deferreds. So that being said, let's kick it to the next one for the interest of time here, because we've got quite a bit to cover still. So I'm gonna try to peruse through these a little faster here. So there's this immaterial decrease in covered taxes election. Basically, there's this general rule in the GloBE rules that says you have to do a recomputation of your ETR and top-up tax for a fiscal year where where there is a prior period tax adjustment that relates to the case of like a decrease of covered taxes. So if there's like a correction and you have to, the general rule is you recompute it for that fiscal year, but there is and you would do it in the current year, right? And what that immaterial decrease is it's really an aggregate reduction that is less than 1 million euro in adjusted covered taxes for that jurisdiction for a fiscal year. So there's this election that says we'll allow you, right, to just include an immaterial decrease in your adjusted covered taxes for that prior fiscal year in the current fiscal year if it's immaterial. Otherwise, you have to go back and rerun the calc and pick up the delta that was missed as an additional top-up tax liability. So going back to that chart in the beginning, that's the middle box there. So you have to file it on a GIR, on an annual basis, and you use this to prevent a full recalc of your ETR and top-up tax when it's really just a small amount. It provides simplification. So continuing on, let's talk about excess negative tax carry forward election. So the GloBE rules do allow you to have a negative tax expense per the administrative procedure, right? And this generally applies where the top-up tax percentages are in excess of the minimum rate of 15%. An M&E group must apply this per the procedure to factor into your adjusted cover taxes. So what this does is if you make an election, you can create an election to carry this forward, right, under the administrative procedure, right, and use this as an attribute to help your to mitigate the detriment to your adjusted cover taxes going forward, right? So the impact here is that if an M&E group here that elects this or is required to apply this per the administrative procedure, right, they would exclude this negative tax expense from its adjusted cover taxes for that fiscal year and instead create it into a account where you can subsequently use it when the timing is right. There's specific rules, and just for the interest of time, since I know we only have 20 minutes here, I'm going to pass through this here. But if there's anyone that has questions on this, please come back and reach out. But you use this really where your top-up tax exceeds 15% in a year, and the excess is basically carry forwards that could be used to reduce your future top-up taxes. So it's similar to the GloBE loss DTA, except it's not a one-time thing. This is something that can help ETRs in subsequent years. So if there's any questions on this, I know we kind of went through this one fast, but for the interest of time, I do want to give others cover other pieces here.
I think that this is an interesting one. So I think it's basically where you have ended up paying top-up tax, or in other situations, you basically get a GloBE tax amount, isn't it? Right. So it's specific to GloBE. It basically carries forward and it reduces top-up tax in future periods. So we have similar things in local jurisdiction rules. If you end up triggering some sort of tax in one year, well, that's potentially an excess tax. You then get to carry it forward against future taxes. So it's good. It's a definite.
Almost like an FTC. It's
yeah.
almost like an FTC from a prior period in a lot of ways.
I'm gonna say yes. But, my US tax knowledge just about good enough to know what you're talking about.
Almost like an FTC, not in the guilty basket.
Yeah, right.
For reference on that. So yeah, so there is an election. So there's also this FX hedge election, right, under the commentaries, right, where it basically allows you to treat FX gains or losses, in FANL as excluded equity gains or losses to the extent that there's FX gain or loss that's related to like a hedge arrangement for currency risks, right? I think of swaps when this happens a lot in the financial services industry that I'm not too privy to. A lot of my clientele is not in that, but for those experts that I rely on, that's usually where it comes in. So you can use this election if those gains or losses are attributable to hedging instruments, right, on currency risks. For you can't be a portfolio shareholding entity for that. Those gains or losses have to be recorded in OCI at the level of the consolidated financial statement. So what this is doing is this is saying this is an item that should be reflected in your FANL, but it's being captured in OCI, so it's not really being labeled as something. And that hedging instrument is effective, right, under authorized financial accounting standards for purposes of preparing consolidated financial statements. So it's treated as a reduction to cover taxes under Article 4.1.3a. The impact is it excludes the gain or loss associated with that, which helps hopefully drive your ETR higher. And you make this election by the filing constituent entity will include it as an election on their GloBE information return, and it's effective for 5 years. So it's a 5-year election. So kicking this off.
It's not. I think it's not just financial services ones. This one, but it's wherever you've got a tax base where the underlying shareholding is going to be taxed on a fair market value basis, maybe, right? But it's denominated in an alternate currency, so you want to make sure that you've actually currency matched it. So you enter into the hedge, and what you want to make sure is that you have got the movement in the value of the currency, so the hedge is actually following the movement in the value of the shareholding, and you haven't got one being effective for tax purposes going through income statement and the other going through OCI. So you want them to line up, and this allows you to do that if you end up with them in the wrong place, mismatched statements. I think it's me now, isn't it?
Yeah, we'll kick you over to the other GloBE elections. So this is really just all the different ones that aren't under Article 3 and 4, but are equally as important.
Yeah, they're spread all over the place, really. The non-excluded entity election is only really relevant, as the name suggests, where you have excluded entities. Excluded entities could be, I don't know, pension schemes, government agencies, those sorts of things. In some locations, those actually pay tax, and they might be paying tax above the 25%. You might end up in a situation where everything else is not really paying tax, and so you have a top-up tax. Well, in that situation, you can elect for the excluded entity to come into the scope of the calculation, drives your ETR up above the 15%, and you don't have a top-up tax. And that's really the only situation where you do it. It's not a cherry pick election, so it falls into the 5-year election bucket.
And Neil, I would add, I've seen this in practice where, some client fact patterns may want to turn on, there's an excluded entity in a particular Pillar 2 jurisdiction where turning on the IIR or, QDMTT for that jurisdiction would actually help save, right? Through just from the charging standpoint, this could be used for that as well. But for the most part, this is where where the excluded entity will help your ETR, right? But I have seen it in the context of trying to turn on an IIR that wasn't that otherwise wouldn't be collected because the entity above it's excluded. So this kind of lets you, choose
right.
how you're going to pay the tax.
Yeah, I've not seen that. I did wonder when I read that part of that bullet point, I was like, I don't really understand that, but thank you for explaining it. I think that's good. So yeah, a couple of different reasons why you might want to turn on something which otherwise you're quite happy is out. The next one, so people who've got into this know the substance-based income exclusion is a complicated exclusion. It's one of the one that needs the most data points. You have to apportion staff costs between jurisdiction. You have to pull out information from all over the place that's not in the ledger. And it's quite an inconvenient calculation to have to do. And if you don't need it in a jurisdiction, then why would you do it? So you can elect on an annual basis in the return to not do the calculation. You can also not do the calculation if you want when you're doing the provisions as well. And if you're already out on de minimis or you're out on the simplified effective tax rate, or indeed when this is for model rules one, so if you're already at like sort of 20% ETR, then there's no benefit to spending all the time, effort and money doing the calculation to get yourself from 20% to 24%. There's no top-up tax in the first place, so all you're doing is wasting your time. So this is a sort of trying to avoid you wasting your time election. The de minimis election is one where you've got small entities, small jurisdictions. I mean, and they really are quite small, right? So it's you need to meet both tests. Aggregate net income is less than €1 million, and the total revenue, so the top line, is less than 10. You can elect to just be out. Again, it's one of those which, if you fall into it, well, why wouldn't you do this election? And it's to try and make sure that if you do have operations, in really small operations in a jurisdiction, that you can get those entities, that jurisdiction out. So I think then we've got the third polling question. Remind me, how does this work? So if I just go on this, does that then mean that people are able to open it? I hope so. So are you interested in a follow-up consultation with Forvis Bazaar? If you click on yes, then unsurprisingly, we will follow up and see what it is that you're interested in. So in terms of the next one, you've got fair value basis election. So this is where in particular, you have some sort of sale, and you're selling, traditionally a company really here, selling an entity, and it allows you to switch between the fair market value and inside basis for the purposes of the GloBE calculations. So been a while since I did one of these calculations from a US tax perspective, but if you have elected, it's effectively to do an inside basis calculation from a tax perspective. The tax and what feeds into your ETR can be very different from the proceeds that you receive, and the purpose of this election is to line the two up so that you don't get pinged for a difference between the proceeds that go through the accounts and the actual tax in circumstances like that. So then this one, there are certain tax regimes around the world where you don't get taxed when you earn the money. You only get taxed when you pay the money out of the jurisdiction. In those circumstances, because you've accrued the profit in your accounts, but you haven't yet, let's say, paid the dividend, so the tax point hasn't arisen, you could end up there with a ETR mismatch. And so what this election allows you to do is to pretend that you have made the dividend, and so that you have paid the tax even though you haven't. It effectively wipes into, like, gives you notional tax for that period in effect, and you have to do it by jurisdiction. So it's an annual election, this one, rather than a 5-year election. So you can turn it off, turn it on again, but it does cover all the entities in the jurisdiction. So if there are different tax bases, that can cause, between different entities in the same jurisdiction, that can cause an issue. A couple of my favorites then for me to finish. So these are the investment entity tax transparency election, the first, so just commonly called the 7.5 election. Really important this, if you do have collective investment scheme or investment holdings within a structure, typically those structures are going to be set up so that they don't suffer tax within the structure. And the transitional measures rules, the simplified ETR, and that they don't apply to investment entities. So absent using these rules, you would have to do a calculation for that investment entity or insurance investment entity by itself. And strangely enough, because the structure's been designed by the tax regime specifically for this, there is no tax. And so you would end up with an ETR. So people who have these structures are absolutely desperate to get either into the 7.5 or 7.6 elections. And that then pushes the income up the chain into the entity where tax is already probably being suffered. So if you take, say, keep coming back to insurance companies, I did warn you, I was the global head of insurance tax. So, but in an insurer, if you own such a structure, the insurer at the top, as the market value movements come in and as the dividends accrue, that's going to be subject to tax, right? So it's paying tax already. So what you want to do is you want to be able to move the income up the chain to where the tax is. And that's what these elections allow you to do. They only apply where there is market value taxation in that top company. But a lot of people, so this, whether you make the election or not, this is a topic of sort of huge importance to anyone with structures that are affected. And then similar to this one, you've got investment structures, a little bit like the deemed distribution one where we spoke earlier. They might not be taxed on a market value basis, but they only suffer tax, really, these structures, when you pay the money out. Here again, what you're trying to do is to match the tax with the investment return. So you'll try here, if you have a tax regime, I think Luxembourg is one of these, and also Ireland in some cases. What you're trying to do is say, right, I've accrued investment return. I haven't paid tax today, but when I pay that investment return out, I am going to pay tax. So you're matching the investment return that you've accrued in the accounts with the tax that will be payable ultimately. Okay, so that's me. I think you've got a few minutes left, Justin, to
so
wrap this up.
Thank you, Neil. Yeah, so let's go through some of the quick ones here. So there's other global elective measures. So technically, the transitional CBCR safe harbor election, which a lot of companies today are using, qualifies as this. And we covered this extensively in our very first session. And basically, this is the CBCR transitional safe harbor, which basically says, we're going to apply the de minimis test using qualified financial statements information on the CBCR. We're going to apply the ETR test, using, with a little bit of adjustments per the, for hybrid arbitrage and things like that. And we're going to also apply this routine profits test, which basically says, if I have enough substance-based income exclusion amount, I can that exceeds my proxy for net GloBE income, I'm okay. So what this is this is only for the transitional period, right? Which ends, it doesn't, it ends relatively after the 3-year transition period. So depending on when your fiscal year ends, so it's temporary, and today a lot of companies there. I won't spend too much time on this since in the interest of time, we don't have much of it. Similar to the transitional CBCR safe harbor, when that expires, there's this intention of releasing a permanent safe harbor that was notified on the 2022 November guidance. Basically, what this is the same, applying the same test on a jurisdictional basis that the transitional CBCR safe harbor test applies. But in this case, what they're looking at is, so there's this thing that there's this kind of like notion in the November guidance that said that CBCR qualified financial statement data is basically kind of like the lowest level of data, but it's the lowest acceptable data, right, for the transition period to give companies time to adapt to these rules. This permanent safe harbor is, you have kind of the spectrum where you have CBCR qualified financial statement data, and you got full scope data. In the permanent safe harbor election, they want you to run those tests kind of in this midpoint, what they're calling simplified GloBE income and simplified covered taxes. The issue with that is we don't exactly know what that is, and the OECD should be releasing this on a go-forward basis. So stay tuned for that. The next piece here is the QDMTT safe harbor election. So, in the interest of time, QDMTT, you run a QDMTT calculation, and if you have any, and you're still required to run a top-up tax calculation. What the QDMTT safe harbor allows you to do is, if you follow these certain standards that have been laid out in the QDMTT safe harbor that was released in July 2023 guidance, it basically says that if you meet this, if your QDMTT computation meets this standard, right, you don't have to go forward and calculate the top-up tax calculation afterward, right? And what they're really getting at is that your QDMTT could calculate, say, $100 of top-up tax in a jurisdiction, and then when you run your full scope calculation, it's more like $102 of top-up tax that your IIR calculation should have picked up. What they're saying is if you follow that standard, right, you could have technically a difference because QDMTTs are variable versus the GloBE rules, which are, pretty nailed down. By having the safe harbor election, this allows you to basically forego having to do that extra data step post calculating your QDMTT. So, without further ado, let's get to the last polling question. I kind of perused through that QDMTT safe harbor, and I think this is the last session. So just to clarify a little bit while you all are answering this, in that QDMTT safe harbor, there's an important thing, right? You have to meet their consistency standard, this administratability standard, and the acceptable financial accounting standard, right, that the jurisdiction has, and that's enumerated in the July guidance, and these slides should be helpful for that. But from a forest view understanding of what the QDMTT safe harbor is basically saying is, hey, you need to first have, you have to have a QDMTT. That QDMTT must be a QDMTT payable. So what they mean by that is that the QDMTT payable, is the amount of actual QDMTT tax you're paying. And what they're getting at is that you could have a QDMTT, but because of a local jurisdiction's constitutional laws, it foregoes having to, it foregoes a little bit of the tax in there. So what they're saying is this QDMTT safe harbor is applicable only to the QDMTT payable. So, when you're thinking about that, that QDMTT payable, you want to make that election or for the QDMTT safe harbor, only in the case where, it's really the only reason you would owe top-up tax is because of a small rounding error. This allows you to simplify that. So, and for those that do have questions on this, I'm happy to answer them. You have our contact info. Looks like we're right at the time mark here, so I will go ahead and just say I do want to say thank you. We know your time is precious, and we really do appreciate your time tuning in here. For those that have been, have tuned in the other ones, thank you. And for those that are just tuning in, that's awesome too. And, we know your time is valuable, especially at a time of year like this. So, we greatly do appreciate the time to talk to you all about this subject. And, if you do have any questions, please feel free to reach out to us. And if we don't, if you don't reach out to us, we do want to wish you all a happy holidays as we enter into this new year, where the next session will be the GloBE information return. So thank you and have a nice day.
Thanks, Justin. Bye.